Good evening. Ira Epstein of Linn & Associates with your SPDR ETF wrap-up for this Wednesday, the August 12th date, 2020, about 6:20 in the afternoon. So we look, another update in the stock market. Okay, so XLK came alive, roaring back. SMH did better too. You're looking at the stock indices coming back alive. A big rally in the NASDAQ from yesterday, SPY. Expect some of these markets going for the highs. But the metal markets, they're staying under pressure. GDX flat pretty much, didn't do much, but it got hit hard yesterday. Silver closing near the low of the day, slightly higher, but we're down pretty good in the futures in gold and silver, so they'll be under pressure if that holds up by the morning. We're going to have to wait and see just what they do. So let's take a look at these charts. I was hoping, and I don't know if I'm going to get it now, that you'd fill this gap in the chart in this 110.47 area right in there. You made a probe into it. If it doesn't, here's what it could do. Let's assume it doesn't, and you get up here and you get another gap to the upside. This could be called a breakaway, then a runaway gap, and that's very powerful if it happens as a chartist. Of course, this is all make-believe because I don't know what the market's going to do. I know the market right here is just churning itself back and forth, trying to figure out what is the next move. When we look at the swing line, we see that very clearly in the swing line. The pattern is now one with a lower low and a higher high. That's not a trend. So you stepped out of the trend when you broke through this low right over here. See this one? That broke through everything, and you've just been basically going sideways since then. Even if you went up and made a new high on the move, you'd end up right now with a lower low, higher high. So it's not able to set up a trend just yet. It could. Outside days can do that, but that's another story. When I look at the moving averages, we haven't even challenged the 18-day average. Each time we have in the past, and I know I've pointed this out to you repeatedly, that is where the market has been able to, if you will, find its footing and then turn around and make a new high literally right away. So am I in the bear camp? I'm certainly not in the bear camp. I'll go on record with that. You got to prove that the market, first off, can stay under that 18-day average and do something more than it's done recently for me to join that camp. When we look at the Bollinger Bands, you can see that you've got your upper Bollinger Band here. You were running on it. You fell back away from it. It's back at resistance now in that 116.77 to 11700 area. When we go to slow stochastics, they are what? Well, interesting day. Let's go to yesterday because this is really fascinating. Notice how the numbers are over 80, over 80, over 80. It's called embedded. When you lose an embedded reading, just the way we did yesterday, not today, I'll show it to you right here. You've got to be careful because it's not often, but it can re-embed the next day. I set that rule up that the next day, what the market has to do is immediately give reason for it to re-embed, which often means not making a lower low, means spiking to the upside. That's your warning. Look at where you opened at the low and nicely higher. That opening was, what was the, I don't have it on, oh yes I do, at 112.28, and yesterday's close was 111.38. So it was nearly $1 higher, and from there all it did is lift right into the close. That gave the market reason for both numbers to come back to 80, and until that's lost, you're still in the bull camp. So this to me is what's being run by this. Drop it again, and it's rare that it comes back after that. Then the odds favor you're going back to the 18-day average of closes. SMH, little different story here. Here you lost the embedded reading. You have it here, you had day after day right here, and then you lose it, not here, but the next day. You also lose it the day after, do you? 72, got it? Now, this was yesterday. What do you think it did today? Gets it right back with it. So both of them, and that's what I started off with, SMH is doing what the XLK is doing. They're back in there. That was a trap. This caught these people bearish. Wouldn't be surprised if you go to the upper Bollinger Band to the highest high for them to scream, ouch, I got caught. I shouldn't have been short. This, to me, runs the chart if it's embedded. When I look at the industrial sector, too many days for me over the upper Bollinger Band. 5 is pushing it. So I'm looking for a correction to the right-hand side of that number. That is not a bear play, it's just overdone. You still have the embedded reading. I look for the buyers to come and give it a little breath under there, and I bet they show up. That's my guess on it. You'd have to lose the red line under 80 for me to say, a complete change. In XLE, just like in the futures, this is just going sideways. We are either carving out one heck of a bottom for prices to keep marching higher in this sector, and it could be a heck of a bottom, or if it reverses and comes down, something terrible is going on in the world economies and it's dropping. I favor it's a bottom simply because I am an optimist. I look that we'll get COVID cures. I look that other things are going to get better. To be the pessimist is not the camp I want to be in. So I do that, and that's just part of what nature is. We'll see if it does that. QQQ, reestablished that uptrend today. So now we've again got higher lows, higher highs. It is overbought. I would look for aggressive profit taking at 276.63. This is no longer the leader. The leader of these markets switched gears into a combination of the Dow, the S&P, and the Russell. When you look at the EFA, this market came alive today and got over its upper Bollinger Band. It has been failing right here, but the combination today, in my opinion, of seeing interest rates climb a bit, the stock market gather its footing, this market came alive and jumped through yesterday's high. This could be a base that carries this market. I've been looking at this for a long time. I know so many market leaders want their clients to be long emerging markets. You've been going sideways. If this is in fact the breakout, there's time here to join in on them, because it's not going to be a 1 week or a 2 week move. If the emerging markets are coming alive, they're coming alive for a long time probably. In gold, the battleground's the 18-day average of closes in your GLD. I don't know where the low is on the break, but I did a special gold report today. Now let me tell you what I did on my report. I covered on the futures market, because this is based on the futures. I did monthly charts. I know traders, I get calls all the time from people writing me, give me something longer term to look at. So I gave you the monthly chart, but most longer term traders really trade off the weekly chart. And I went into the weeklies in great detail. I then brought out for you a combination of the 30-year, the 15 and the 5-year patterns in gold from right now forward through the rest of the year so you could see them. I showed you bull years, bear years, and neutral years on those charts. They're from our good friends at More Research. The next thing that I did is I went in, gave you price counts, and then I wrap it all up for you with daily charts, a complete analysis. It's on our website, www.iraepstein.com. under the word research, and this is all covered there. So this break, as big as it is, the weekly charts aren't going along with the daily chart break, I can tell you that. When you look at the gold miners, as I said, I think yesterday the pros covered shorts. You had a heck of a bounce, but it all fell apart at the end of the day. You're very oversold in the market as well. There's no reason to be long. The trend is down, but you are oversold into a temporary support zone. Bollinger Bands are important. TLT, as I said, I was looking for this market when you lost the embedded reading to make a run to the 18-day average of closes at 169.22. It did just that. And that's where I think the market's now got to figure out the next move for interest rates. Last, we've got the FXE. It held what it had to. Came down, did not take out this low. Does that mean it's rip-roaring back to the upside? Not at all. You've still got momentum that is gradually pointing down. You've got the bias up and the trend up. Take out this 110.50